probably underappreciating that we could get a modest overshoot. I think with the Fed policy in place, if we get anything like Trumponomics, we probably will see a modest overshoot.
What are you recommending to PIMCO portfolio managers? I mean, I know you and Scott Mather aren't on speaking terms, but when you have you talk to the great
my best buddy Scott Mather,
but he's in the real world. He's in the trenches of trying to manage money in Clarida's world. What do you tell him?
Well, no, we do think that that medium term that you definitely want to have inflation protection. Markets now, those break-even inflation rates have dipped below 2%. We think that should be an anchor, really should be a floor. So that's a key part of it right now.
We welcome all of you on Bloomberg Television and Bloomberg Radio today, particularly on Sirius and XM across the nation. Scarlett, it's going to really have an impact on the nation. Not so much this increase, but I've got it up here. I don't have these memorized, folks. May 3rd, June 14, July 26, September 20 is where you're going to share the Stanley Cup, and Rick Lundquist is going to bring it over here. For a visit, November 1st, and then to December 13, where then you really wonder about the tenure of Chair Yellen.
Right, and we're also looking at, of course, at the calendar because some of those meetings are live and that there will be a news conference, others won't. Rich, do we need to get away from the idea that there are live meetings and dead meetings, that the Fed can go at any time, really, from here on out?
Well, and of course they can. In the past they have. I actually think the Fed should go to a press conference at every meeting, and I think that would solve a couple of things.
We'd have better. Mr. Draghi does.
We would have better, more consistent communication, and we would fix very simply this whole notion of live and meetings that are not so live. I think we could get a surprise out of this Fed. They could go just to show that they can at a non-press conference meeting. But the simplest way is just go to 8 press conferences a year.
Neil, how impressed were you by the Fed's ability to shift the market consensus over the last 2 weeks? I mean, it was a very determined effort to get people to convince that we're going to have a rate hike in March. And 2 weeks ago, most people didn't think it was going to happen.
Yeah, well, again, I think the fact that we got a little more inflation in all the various numbers contributed a lot to that as a backdrop. I think the other thing is that there is, I think, a growing sense that more of this fiscal program from the Trump administration and from Ryan's agenda, if you will, is going to come to pass. That raises either a Keynesian kind of demand stimulus in the short run, or it raises potential GDP in the long run, or both, as the case may be. Either any of those justifies moving a bit faster, at the very least, towards whatever the long-term rate is. And I think there's a little bit of concern, this is reflective of Judy Shelton's comments, that somebody may put a lot of pressure on the Fed with respect to the balance sheet. And the more balance sheet adjustment that one contemplates, or the sooner you contemplate it, the more that really changes financial market
I'm glad
dynamics.
you bring this up, Dr. Suss. Dr. Clarida, here we have a balance sheet. Are we just going to let it go out into the future, or would you presume action?
Well, I think the Fed does want to shrink the balance sheet. What's frustrating, I think, to Neil and I and other Fed watchers, is they've had 5 years to develop a plan, and they're still talking about it. So the short answer is a lot of the key details we don't know. What I do expect is they'll begin to taper the balance sheet next year. They probably won't sell anything, but they'll let securities roll off. But that process will take a long time, well into the next decade, really, until the balance sheet gets back to more normal level under that approach.
And it's a much more complicated business than it would have been in the old days because of these so-called high-quality liquid asset requirements that banks have, which are satisfied ideally, so to speak, by holding reserves at the Fed. But if the Fed has liabilities, it must have assets by the constraint.
The Fed holds a lot of mortgages as well, and so that has implications for the mortgage market, depending on how they work that portfolio down. I wonder about the Fed communication. What's interesting, they moved that probability, Scarlett, but it wasn't Yellen and Fisher. It was Rob Kaplan in Dallas. It was Dudley. It was Rosengren. It was Lael Brainerd, and actually only Chair Yellen and Stan Fisher right at the very end sort of came on when that had already been priced in. So this is a case where the district bank president only moved the needle on that hiking probability.
But it was a concerted effort. It was kind of like a drumbeat all the way through.
Well, it was certainly a correlated effort. I don't know how coordinated it was, but it was very well correlated.
All right. We've got, of course, Rich Clarida of PIMCO, and we've got Neil Stoss of Credit Suisse. Let's get you a quick data check before we get to the announcement at the Federal Reserve. We're looking at equities buoyant right now. modest gain there. The S&P 500 holding about 1% below record highs. When you look at Treasuries, the 2-year yield, of course, is the one that's more sensitive to what the Fed does next. And you can see, of course, that the 2-year is falling, so that means a higher yield. Earlier, it was up as much as, actually, it was up much more than that before. It's come back a little bit. And NYMEX crude, of course, we're back from that 47 handle, up a little bit from that level. Let's go over now to Kathleen Hayes, who's at the Federal Reserve in Washington.
Federal Reserve raises